Your morning coffee costs more than it did last year, and it's not because the beans got fancier. It's because your money is quietly losing value every single day. This slow, invisible leak in your wallet has a name, and it's called inflation. Today, I'm going to show you exactly how it works and how to protect yourself against it. So what exactly is inflation? In simple terms, inflation happens when the prices of everyday items, like a cup of coffee, a gallon of gas, or even groceries, rise over time. When this happens, your money loses value because it buys less than it used to. For example, in 2015, the average price of a loaf of bread was around $2. By 2025, that same loaf could cost $4 or more. It's the exact same bread, but it takes more money to buy it. That's inflation reducing your money's buying power. Another example of this is gasoline. In the early 2000s, gas in the US averaged about $1.50 per gallon. By 2010, it was around $2.70. And in 2025, many places see gas prices anywhere from $3.50 to $5 per gallon. It's the same gas, but the cost keeps climbing, while the value of money keeps shrinking. It might feel like things are just getting more expensive, but really the money we use is losing its value. So the real question is, why does this happen? Inflation can happen for many reasons, but this video will cover the main reasons why. Let's start off with demand pull inflation. Demand pull inflation happens when the demand for goods and services increases faster than the economy's ability to produce them. This means a lot of people want to buy something, but there isn't enough of it. An example of this is bread. Imagine a small bakery that bakes 5 loaves of bread each morning. Normally 5 regular customers come in, and everyone happily pays $2 per loaf. But one day, something changes. 5 more people walk in wanting that same bread. Now there are 10 people, but still only 5 loaves. Some customers are willing to pay more just to make sure they get a loaf. Seeing this, the baker raises the price to $4 per loaf. The reason this happens is because there are a lot of people who want to buy the bread but not enough bread to go around. A simple way to remember demand pull inflation is too many buyers, not enough bread, so the high demand for the bread pulls prices up. The second type of inflation is cost push inflation. Cost push inflation happens when the cost of making goods goes up and businesses raise prices to cover those higher costs. Let's imagine the same bakery now makes chocolate chip cookies. Each cookie sells for $2. The price per cookie breaks down like this: 50 cents for the chocolate chips, 50 cents for other ingredients and production costs, and $1 profit for the baker. Now suppose the price of chocolate chips rises an extra $1 due to a poor cocoa harvest, making the demand for cocoa higher. The bakery now has to spend more to make the same cookie. To keep earning a profit, the baker raises the price of each cookie from $2 to $3. A simple way to remember cost push inflation is when production costs rise, businesses push prices up. The third type of inflation is built-in inflation. Built-in inflation, also called wage price inflation, happens when prices rise because workers expect higher wages and businesses raise prices to cover those wages. Now let's imagine all the goods in the bakery increase in price because of the overall higher cost of production, like taxes, the bakery's rent, and ingredients. Because of these costs, it makes every baked good increase $1 per item. Since the higher cost of living, the employees take notice and demand higher wages to keep up with the cost of living, so the bakery increases the price of goods by another $1 to keep up with production costs. This creates a cycle where prices and wages just keep pushing each other up. Now there is another type, and probably the most talked about type of inflation, and that's when there is too much money in the economy. When there's too much money in the economy, prices can rise across the board. This happens when governments spend too much, or when central banks print too much. For example, let's say the bakery is selling 3 cakes at $30 per cake, and there are 3 people each with $30. Since there are only 3 cakes and 3 people, each person buys a cake for $30. Now, if the government comes around and gives everyone another $30 in stimulus checks, because people now have more money to spend, everyone rushes to buy more cake. Because of the higher demand for cake, the bakery raises its price of cake from $30 to $60. Now that you know what inflation is and how it works, we are going to see how inflation is calculated. There are several different ways to measure inflation, but for the sake of time, we'll focus on the most common one, the Consumer Price Index, or CPI for short. We'll cover the other methods in a future video, So make sure to like, subscribe, and turn on notifications so you don't miss it. Now back to the video. Consumer Price Index is basically a way of tracking how much the average household's cost of living changes over time. Imagine a shopping cart filled with everyday items like groceries, rent, gas, healthcare, and even things like movie tickets. Economists keep track of how the total cost of that basket changes from year to year. If the basket cost $100 last year and $105 this year, that means prices rose about 5%, and that's the inflation rate. But here's the catch. Not every item in that basket moves at the same pace. Some prices may stay the same, while others might rise much faster than 5%. CPI is just the overall average, which is why it sometimes feels like certain things, like groceries or gas, are climbing way faster than others. So now that we know how inflation is measured, by looking at changes in that basket of goods, the next question is, what's a healthy amount of inflation? Most governments and central banks aim for about 2% per year. Why? Because it's the sweet spot, not too hot, not too cold. At that level, money holds its value while the economy keeps growing. But what happens when inflation moves away from that target, either higher or lower? For example, let's say inflation rises to 5%. Central banks will take action to cool the economy down. First, they will raise interest rates, which makes borrowing more expensive and slows down spending and investment. Then, they may reduce the money supply, meaning governments cut spending or increase taxes to take money out of circulation. The goal is simple: slow down the economy so prices stop climbing so fast. Now, what if inflation falls below the 2% target, or even turns negative? In that case, central banks try to stimulate the economy. They lower interest rates to make borrowing cheaper, encouraging households and businesses to spend and invest more. Sometimes they also inject money into the economy through stimulus programs or quantitative easing to boost demand. In essence, central banks act like the thermostat of the economy, heating it up when it's too cold and cooling it down when it's too hot. Now, the real question is inflation a good thing or a bad thing? Well, it depends how you look at it. Inflation can help some people while hurting others. For example, if you have debt, moderate inflation can actually work in your favour. That's because as prices rise, the real value of what you owe decreases over time. Homeowners with a fixed rate mortgage or businesses with valuable assets like property or stocks can also benefit. On the other hand, people on fixed incomes like retirees relying on pensions often get hurt. Their income stays the same, but the cost of living keeps rising, so their purchasing power drops. Savers can also lose out because money sitting in a regular savings account loses value if interest rates don't keep up with inflation. Even businesses can struggle if their costs rise faster than the prices they can charge, which shrinks profits and makes planning harder. If you're worried about inflation, the best way to protect yourself is through investing. Here's why. Inflation causes prices of goods and services to rise, so the money you hold loses purchasing power over time. Let's go back to 2010 and look at two people, Matthew and John. Matthew is a saver. He puts $10,000 into a regular savings account, earning just 1% interest per year. John, on the other hand, is an investor. He puts his $10,000 into the stock market, which on average grows around 7% per year. Fast forward 15 years to today. Matthew's savings have grown to $11,610, and John's investment has grown to $27,590. But these are just nominal numbers, not adjusted for inflation. To see the real value, we need to account for 2% annual inflation. With inflation, Matthew's savings are really only worth about $8,626, meaning he actually lost purchasing power over time. The 1% interest from the bank wasn't enough to keep up with rising prices. John's investment, however, is worth about $20,500 after adjusting for inflation. Investing not only protected John from inflation, it actually increased his real wealth. In conclusion, inflation is a natural part of any economy, reflecting rising prices and the changing value of money. While moderate inflation can signal a growing economy, unchecked inflation erodes purchasing power and affects everyone. Understanding inflation helps you make smarter financial decisions, plan for the future, and protect the value of your money. Just remember to learn as much as you can. Don't throw your hard-earned money into something you don't know and understand. It's best to do your own research or speak to a financial advisor. Thanks for watching. We hope you enjoyed the video.